We're analyzing Nasdaq, stock ticker NDAQ, to see if it's a great business on sale. This analysis is around 10 minutes. It's going to be intense, but it's going to be worth it. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for Nasdaq. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing Nasdaq for your stock portfolio. Before we get into these valuable metrics, let's understand Nasdaq stock performance. Right now, Nasdaq trades for $51.65 per share. Year to date, their stock price is down nearly 18%. This is underperforming the market. The company had a big decline after their June 2023 earnings call. Right now, Nasdaq pays a 1.61% dividend yield. Their average dividend yield is added to the returns in their stock. In the last 5 years, Nasdaq's compounding at 10.5% annually. In the last 10 years, they're compounding at 17% annually. They're beating the market over this time. Going back before the global financial crisis, in the last 18.5 years, Nasdaq stock is compounding at 16% annually. The company's up around 17 times. Nasdaq trades just $3 above their 52-week low. The company's down $18 from their 52-week high. Just over 1% of their shares are sold short. Nasdaq's a big business. They have a $25 billion market cap. But the burning question is, why should we be paying close attention to Nasdaq? Founded in 1971, Nasdaq is primarily known for its equity exchange, but in addition to its market services business, which are about 35% of sales, the company sells and distributes market data as well as offers Nasdaq branded indexes to asset managers and investors through its information services segment, which is 30% of sales. Nasdaq's corporate services business makes up 20% of sales. It offers listing services and related investor relations products to publicly traded companies. Through Nasdaq's market technology group, which makes up 15% of sales, Nasdaq facilitates the exchange operations of other exchanges throughout the world and provides financial compliance services. Now let's get into the numbers. Starting with metric number 1, we want Nasdaq's average return on capital in the last 5 years to be above 14%. The average business earns 7% returns on capital. Looking for a benchmark that's double this can build in margin of safety based on the quality of the business. Over the long run, over the course of decades, a stock's likely to return what its underlying business returns. Nasdaq has earned solid and stable returns in the low double digits. In their last year, they earned 13.5% returns on capital. When these are averaged out, Nasdaq earns 11.8% average returns on capital in a given year. That's a handful of percentage points above a typical business, but it's a couple percentage points below the benchmark we're looking for. This means even though they earn above average returns, this is an X on metric number 1 for Nasdaq. Metric number 2, we're looking for 5-year revenue, net income, and free cash flow growth. All three need to be up for it to be a check. This metric's all or nothing. We'll include their last 12 months worth of numbers when we calculate this growth. Their most recent numbers won't show up on this chart. In this time, Nasdaq's grown their revenues by 43%, their net incomes or their earnings have more than doubled, and Nasdaq's free cash flows have grown by 69%. This is growth across the board. Potentially nice to see that Nasdaq's net incomes and free cash flows have grown faster than their revenues, as this gives the business some operating leverage. This is a check on metric number 2. Metric number 3, we're looking at Nasdaq from the view of an individual shareholder. We want to see earnings per share growth in the last 5 years. In our previous metric, we learned that their net incomes or their earnings have doubled over this time. Nasdaq's also bought back 1% of their shares outstanding. They've offset some shareholder dilution, but this is likely better than them diluting shareholders overall. Because of their earnings growth and these very slight share buybacks, this is a check on metric number 3. Metric number 4, we're looking for free cash flow per share growth in the last 5 years. This is a similar story. Their free cash flows have grown by 69%. Plus with these slight 1% share buybacks, Nasdaq's grown their free cash flows per share. This is a check on metric number 4. To recap where we stand currently, through 4 metrics, Nasdaq has 3 checks and only 1 X. Let's see if they can keep this going. During recessions, it's overly levered businesses that can have the biggest losses. Metric number 5, we want Nasdaq's net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of their free cash flows in their last 5 fiscal years. Nasdaq's increased their net debt over this time. They ended 2022 with just under $5.4 billion of net debt. Today, they've reduced this. Right now, they have $4.9 billion of net debt. This is still up from where the business was at in 2018. However, when we add up their free cash flows in their last 5 fiscal years, Nasdaq's generated $5.3 billion of free cash flow over this time. This is $400 million above their net debt position, meaning it looks like Nasdaq supports supports this. This is a check on metric number 5. In their last 12 months, Nasdaq generated $1.5 billion of free cash flow. If we projected that out over the next 5 years, it looks like Nasdaq generates enough free cash flow to support the debt they're using. Before we estimate a value for Nasdaq, we can't forget about our bonus. As our bonus, we're looking at Nasdaq's dividend profile. Right now, Nasdaq pays a 1.61% dividend yield. We want their dividends to be supported by their free cash flows in all 5 years. Nasdaq has grown both their dividends per share and their free cash flows per share over this time. They've also comfortably supported this dividend growth, maintaining a reasonable dividend payout ratio in all 5 of these years. Nasdaq's even grown their free cash flows faster than they've grown their dividend. This is almost exactly what we're looking for. While this is a snapshot of their last 5 years of performance and it's no guarantee for the future, this is a check on our bonus. The big metric of them all, metric number 6, we want Nasdaq's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we're estimating a fair value for Nasdaq. Right now, Nasdaq has a $30 billion enterprise value. This accounts for both their net debt position and their market cap. It looks at Nasdaq similar to it being a private company. In the last 5 years, we learned Nasdaq generated $5.3 billion of free cash flow, meaning they generate just under $1.1 billion of free cash flow in an average year. When that's divided by their $30 billion enterprise value, we get around a 3.5% average free cash flow to enterprise value yield. On a current basis, Nasdaq produced $1.5 billion of free cash flow in their last 12 months. When that's divided by their $30 billion enterprise value, we get almost exactly a 5% current free cash flow to enterprise value yield. That's right at that risk premium we're looking for, a little bit ahead of the yield from the 10-year treasury, but we're looking at Nasdaq on an average basis here, as free cash flows can be lumpy year to year. Because of this, their average yield is under that risk premium we're looking for. This is an X on metric number 6 for Nasdaq. Don't just throw the business out, we still need to estimate Nasdaq's fair value per share. Everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze Nasdaq, which takes us on to using a discounted cash flow model to estimate their fair value per share. A DCF model is based on the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. We're starting with an average of Nasdaq's last 3 fiscal years worth of free cash flow, then using historical assumptions to grow these into the future. It's up to you to figure out if these will be accurate or not for Nasdaq. Nasdaq's been a somewhat predictable business in their past, which can potentially inform these assumptions. Assuming they grow their average 3-year free cash flows at just under 12% annually for the next decade, then assuming this growth rate is cut in half and these grow at 6% annually for the following decade, we're adding in their tangible book value to give an estimate of their net worth. Keep in mind, Nasdaq is a relatively asset-light company, so this could be skewed for the business. If we want a 15% rate of return, which is what Warren Buffett looks for from his investments, if today's valuation multiples are the same 20 years into the future, an estimate of Nasdaq's fair value per share is around $23. That's down less than half from their current stock price. Keep some key points in mind. Just because Nasdaq's been somewhat predictable doesn't mean that that's a guarantee for the future going forward. Certain segments of Nasdaq also greatly benefit when there's more trading activity in the market or when there are more public listings, so Nasdaq can fluctuate with downturns. Looking at a longer-term chart of their free cash flows, it's no surprise that both after the dot-com bubble and during the global financial crisis, Nasdaq saw a hit to its free cash flows. Also, the company's free cash flows have really skyrocketed in recent years. That's something you want to be mindful of. This discount rate is an estimate of total returns to shareholders based on Nasdaq's free cash flows. It would include both their average dividend yield and any potential gain in their stock price. Keep in mind, this is not financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll give our final rating to Nasdaq, but we need to address something first. We've looked at the numbers, but the qualitative factors for Nasdaq's business are even more important. Why don't we find out what they are? Looking at the factors supporting a long thesis, number 1, the company's listing business has outperformed in recent years, winning the majority of newly listed securities. Number 2, Nasdaq's market data and brand are valuable and tangible assets that the company has monetized through its listing, index, and data products. Number 3, Nasdaq continues to see strong growth from its newer, more data-focused business lines as the company continues to invest in its data and technology offerings. But it wouldn't be fair if we didn't cover the negatives of Nasdaq's business business as well. Looking at the factors supporting a short thesis, number 1, Nasdaq recently bought the financial software company Adzena for $10.5 billion. The Adzena acquisition will not be cheap. At 18 times expected 2023 revenue, Nasdaq's paying a significant premium, creating risk for shareholders if the firm cannot execute on its planned revenue and expense synergies. Number 2, Nasdaq has seen considerable industry and regulatory pushback on the pricing of its market data products, limiting its ability to grow revenues through price increases. Number 3, Nasdaq continues to face growing competitive pressure at its exchanges, with 2 new competitors launching in 2020. There you have it for a balanced perspective of some of Nasdaq's qualitative factors. Now it's time to talk about our rating. In analyzing Nasdaq, stock ticker NDAQ, we learned this capital markets company behind the Nasdaq 100 and the Nasdaq Stock Exchange earns above average returns on capital. They've grown their revenues, net incomes, and free cash flows, experiencing some operating leverage along the way. Shares outstanding are pretty much the same with only very modest share buybacks. While Nasdaq uses some debt in their business, it looks like their free cash flows are able to support this. Nasdaq's free cash flows also support a growing dividend, both in their last 5 years and today. Again, this is not financial advice. While Nasdaq's current free cash flow is in line with the yield from the 10-year treasury, their average free cash flow yield is below what we were looking for. When we perform our discounted cash flow analysis, if today's valuation multiples are the same 20 years into the future for Nasdaq, you believe those assumptions and you want a 15% rate of return, an estimate of Nasdaq's fair value per share is around $23. Nasdaq last traded around those levels in the summer of 2017. You'd want to be patient, but it seems that aligns with their actual stock performance. Again, this is not a buy or sell recommendation of any security. Consult with your financial advisor. Looking at all the factors of our analysis, Nasdaq looks like a moderate candidate for further research. If you enjoyed today's video, be sure to like it, subscribe to the channel for more stock analysis videos, share your thoughts about Nasdaq, and let me know what business to look at next in the comments below. Thanks for learning about Nasdaq with me, and have a great day.